And so I decided I'm going to do that with my money, take it out of Wall Street and start investing in companies that I would meet when we would go to B Corp conferences or employee ownership conferences or cooperative conferences. And over time, my personal impact investing portfolio grew and grew.
This is the Angel Next Door podcast, where we will talk about all things angel investing, what it is, who does it, how do we find them, what does it mean to invest in an early stage company. If you have ever wondered how you can affect the change you want to see in the world, then tune in to learn more.
In this episode, I'm talking with Blake Jones, co-founder of Namaste Solar and the Kachuwa Impact Fund. He shares his extraordinary journey from oil and gas engineer to impact investing pioneer. We discuss how Kachuwa harnesses the power of cooperatives, democratizes investment opportunities, and supports social good through a uniquely diversified portfolio, including real estate, affordable housing, and startups. Blake breaks down why slow and steady wins the race, reveals how co-ops actually work, and offers real-world examples of doing well while doing good. Enjoy the show. Well, Blake, welcome to the Angel Next Door podcast.
Thanks. Happy to be here.
I am really excited for you to come on the show and talk to us a little bit about Kachuwa and this model that you have for investing in impact. I know when I first learned about it, I thought, wow, you're investing in things that actually can spit off revenue and have some type of return. And then you're also investing in longer term things. So we're going to get into all the details, but definitely let's start out. Tell us a little bit about your background and then how did you get into this?
By accident is the short story. I studied engineering and went to work in the oil and gas industry after graduating college. And then I have an environmentalist older brother who helped me transition my passion for fossil fuels into a passion for renewable energy, and fell in love with the renewable energy industry and went to work in Nepal for a few years doing renewable energy, and came back to the United States and became an accidental entrepreneur with two others. It was just good timing to start a solar company here in the United States in 2004. And none of us had an MBA. We didn't really know what we were doing, but we started that company and we thought, we're going to do this. We want to do it differently than the way we'd seen it done. And so we started it as an employee-owned company in a very flat hierarchy, democratic workplace. And it turned out that attracted a lot of amazing people to come work with us. And that company's name is Namaste Solar. It's now 21 years old. Mm-hmm. And a big part of its success is due to being an employee-owned cooperative. And we were growing so quickly in the early days that we needed to raise money. All the employee owners were investing money in the company, but we still needed more. And we didn't want to take money from the usual suspects, from angel investors, or we had VC funds calling us all the time. And solar was hot at the time. And we knew that would spell the end of our employee-owned cooperative. And we didn't know if there were investors out there who wanted to invest in what we were doing. And we were pleasantly surprised that there are. That's where I learned the term impact investor. And over a couple of years, we raised almost $5 million from 125 different impact investors who invested in us because of being an employee-owned cooperative, of being a certified B corporation, because we were in the solar industry. They were looking for just that type of investment. And I would interview the investors to make sure that it was a good fit. And in interviewing them, I was so inspired to hear how they invested in alignment with their values and how they were finding these investment opportunities. I'd ask them, what else are you invested in? How are you finding these? And so I decided I'm going to do that with my money, take it out of Wall Street and start investing in companies that I would meet when we would go to B Corp conferences or employee ownership conferences or cooperative conferences. And over time, my personal impact investing portfolio grew and grew. And then fast forward a decade later, friends and family and colleagues were saying, wow, you've got the most exciting portfolio. Those are neat companies. That's the kind of companies that I want to invest in. How can I do that? And that's where I've learned about you need to be an accredited investor to participate in a private offering. A lot of private offerings, the minimum investment amount is very high. So a lot of the people who were asking that, they learned that they couldn't actually do that themselves. And even if they could, they need to know how to find the deals and how to do due diligence on them, et cetera. So they asked, can we just piggyback on what you're doing, Blake? And so being a co-op enthusiast, I thought, yeah, let's do it. Let's just do it as a cooperative. And so that's how we started the investment cooperative. And then fast forward to today, now it's got over 300 members. It's got a portfolio of almost 100 assets that total about 65 million. So it's been snowballing ever since.
Amazing. So explain for our listeners who don't know exactly what a cooperative is, how it's structured.
Yeah, I think most of us may not be aware that there are cooperatives all over the place. There are a lot of farmer-owned cooperatives like Land O'Lakes and Organic Valley and Sunkist. There are purchasing cooperatives like Ace Hardware and True Value Hardware. There are financial services cooperatives, which are also called credit unions. I didn't know that credit unions are cooperative banks. There are co-ops all over the place, but the one of the hallmarks of a cooperative is that it's got democratic governance. So you can invest more in the cooperative, but you're only going to get one vote. So I like the hallmark. And it's one member, one share, one vote. And usually, if you invest additional amounts in a cooperative, it's going to be in the form of a non-voting share, non-voting stock, so that it stays as a democratic form of governance and shareholder control. That doesn't mean that you make operational votes democratically. It just means at the shareholder level, like at Kachuwa Impact Fund, we have investors who invested more than $1 million, and some of those invested as little as $5,000, and you get a proportional financial return on that, but everyone only gets one vote. So that's one example of what it means to be a cooperative. Just another one is that it's owned by the members who utilize the cooperative. So if you're a member of REI, like a lot of people have heard of REI, you're buying your outdoor equipment from REI. Those are the members who comprise the ownership group. Or if it's an employee-owned cooperative like Namaste Solar, it's the employees who work there that are the owners. And if you're a organic dairy farmer, only those organic dairy farmers can be the true members or the owners of Organic Valley, the agricultural cooperative.
Interesting. Then explain a little bit how that works when it comes to Kachuwa Impact Fund. There are shareholders, everybody has one vote, even regardless of what dollar amount people put in. Then what is it that they actually can vote on? Because they're not doing like day-to-day operational things, right?
Yep. It's the same thing that shareholders vote on at other companies. So usually the board of directors is the primary thing, whether or not to sell the company or to liquidate all the assets of the cooperative. So that's the primary thing. And cooperatives, since cooperatives have a very democratic form of governance and good democracies that have good checks and balances, another example of something that our members vote on is our board of directors can't vote to compensate themselves more without the co-op members approving it. But those are the main things. Shareholders, what shareholders vote on at any other company, those are the things that shareholders at cooperatives vote on too.
Interesting. Okay, so Kachuwa Impact Fund has about 100 assets inside the fund. So tell us what types of assets they are and how you find them.
By design, more than 60% are real estate, mostly commercial real estate, like industrial flex spaces, warehouses. But also we have 2 affordable housing apartment buildings, but more than 60% of it's real estate. So we're technically a real estate cooperative, a real estate company. And then with the other 40%, we invest in all different types of investments in private companies. So debt, equity, revenue sharing agreements, safes. But we also make a lot of limited partner or LP investments in professionally managed funds. So we have a little bit of everything. And the goal is to diversify the portfolio as much as possible in all these different asset classes, which is for the good of the cooperative and for the good of all the co-op members, because we're trying to make it more friendly and accessible and welcoming to investors. But if investor only has a limited amount to invest, we want to make sure that they're not having all their eggs in one basket by participating in one private offering and one direct investment in one company.
Right.
They can invest in our co-op, and it's a very diversified portfolio with all these different asset classes and reduces risk as a result. We also have a low investment minimum, $5,000, which makes it more accessible. And then we're also not a partnership. We're a corporation, or a cooperative corporation. So we don't do K1 tax forms, which is we're a pain in the neck. Nobody likes K1s. So we do give up that tax advantage of being a partnership. But one of the benefits, the upsides, is that we're issuing everybody a 1099 DIV tax form every January. It's very simple, very easy to incorporate into your taxes. And so those are some examples of ways which we try to be accessible and welcoming to investors.
Yes, that is very much, that's so much better than a K1. And you're very good about getting them out very early. So yes, full disclosure, I am an investor in Kachuwa Impact Fund. And I think you were the first tax document I actually got this year. So
Good to hear it.
that's exciting. I know last year it was September 15th and I was still waiting for K1s. So
Yeah.
that's how it goes. Yeah. Anyway, okay, we could gnaw on that all day. But let's talk a little bit about why people are getting a 1099 dividend document. It's because you're giving out an annual dividend, and that's basically from the revenue that you're getting off of the real estate. Is that right?
Yeah. And not just that, but the other asset classes too. 60% is real estate. And you're right. With leases, it's rental income coming in every month. It's cash flow as well. It's got good income. That's great to have in our portfolio. We do invest in startups, but startups are limited to 30% of the non-real estate portion, which is up to 40%. So less than 12% of our portfolio are startups. And those tend to be waiting for a capital gain, which can take a while. But we invest in a lot of other companies that, for example, cooperatives and employee-owned companies, where they're selling a share of non-voting preferred stock that pays a target dividend every year. And a lot of these companies have been around for 30, 40 years. They're profitable, they're well established, and they're generating great dividends. We also provide loans. So we'll do loans to CDFIs, community development financial institutions, loans to nonprofits. Those generate interest. We'll participate in loans to like clean energy loans for people putting solar panels on their roof. We'll participate in a pool of those loans. So all the different types of asset classes, a lot of them are generating capital gains, which are lumpy, but a lot of them are generating steady, consistent income month in, month out, year in, year out. And that's what we use to pay dividends to our co-op members. And we take 100% of our net income each year and we pay that out in dividends. So we pay out all the profit.
Interesting. So what happens like when one of the startup companies, let's say, hits it big and now there's a payout? Will it work the same way?
Yep. So that capital gain that happens in that year, and there may be multiple capital gains out of the 100 assets we've got. Others are generating income, not capital gains, but all of that gets aggregated and consolidated onto our income statement. And then whatever the profit is that trickles down to the bottom line, that's what we're paying out to co-op members. So all the different sources of income, all the different types of income, it all belongs to the cooperative. It all belongs to the co-op members.
And so then it's simply divvied out. You did say this before, but just to clarify, it's divvied out by the percent of however much people invested in the first place.
Yep. Essentially, we pay out our dividends. They're called patronage dividends in the co-op world in accordance with cooperative principles. And this is another difference between an investment co-op and a conventional fund, is that in a conventional fund, you might have a share price that's going up and you're doing net asset valuations or NAVs. And we don't bother with that. We have fixed price shares. So if you invest $5,000 in 2026 and you're a member of the co-op for 10 or 15 years and you're ready to leave the co-op later, the goal would be to give you your $5,000 back and for you to have earned dividends all along the way. It's fixed price shares. In a conventional fund, you want your share price to go up. And that's one of the main ways in which you make money is by exiting the fund at a higher share price. With us, it's what is the actual income that the co-op is generating. Net asset valuations are very speculative, usually very inaccurate and time consuming. And we just don't go there. So it's all about what is the actual income that the cooperative is generating. And we divide that up. But bear with me here. The type of income that's predictable, annual income like rental income from our real estate. I've got a signed lease, you know what that rental income should be. We divide that out over the course of the year that it was earned. So if you join the cooperative and you invest $5,000 on January 1st and I invest $5,000 on July 1st, you would get twice as much of that type of income as I would because you were invested for the entire year. I was only invested for half a year and we both invested the same amount of money. If we have a big capital gain, like when we sell real estate, say we sell it 20 years later, or one of our startups has a big liquidity event and exit, that capital gain is divided differently. It's divided over the period of time that we owned that asset. So if we own that real estate for 20 years, and I'll do easier math, if you invest $1 for all 20 years that we own that real estate, you would have $20 years of patronage. If I invest $1 in the final 2 years that we own that real estate, I would only have $2 years. That capital gain gets divided up proportionally between us based on how much money over what period of time we had invested in the cooperative during the period of time that we owned the asset. So it's a little complex because it's a new concept, but mathematically it's very straightforward and it's a very fair way to divide up the income that the cooperative generates without needing to bother with highly speculative, inaccurate net asset valuations.
Yeah, that's really interesting. And that makes sense. If somebody's an investor for longer and there was some type of a gain, they should get proportional returns for the time and money they invested, right?
Yep. And someone could argue, well, the value of that real estate really shot up in the final 3 years because of the new baseball park that was built in the area. Sure, someone could make that argument, but our co-op is all about long-term thinking, making long-term patient investments. And so we're valuing all years equally, not years in which you can speculatively argue that market value increased more during these years or those years. It's all about the long run. We want to look at it in the long run, and we value time equally.
Great. And so how do you source deals?
So we benefit a lot from our membership. We have a lot of members who are angel investors. We have a lot of members who are working in the co-op world, cooperative organizers. We have a lot who are just impact investors themselves, and we get a lot of deal flow from our membership. Or they might know a nonprofit in their area where the nonprofit has made that area their home for a long time, but the landlord's going to sell the building out from underneath them, and they need help buying that building because they want to stay there. We do a lot. That's usually how we find a real estate deal, is to help a private impact company or a nonprofit to gain control of their real estate destiny. We'll buy the building for them and share ownership with them over the long run so that they can stay in the building they want to stay in. Then we'll also just have members who say, you know what, I know the restaurant in my neighborhood. We love it. We've been going there for a really long time. And the owners are baby boomers and they want to sell to their employees and they're converting to an employee ownership model, but they need financing in order to do that. That's exactly the kind of project that Kachuwa is interested in. So mostly from our members, but also it's nice that word has spread. And so we get a lot of deal flow from all different sources. And it's great to see a lot of inspiring companies come our way.
So go back to that example you just gave, because that's super interesting. And we had Gina Schaefer on the podcast before, who actually, she was part of Ace Hardware chain and she had several stores, and she has slowly been exiting through an employee stock option program. So how, in that example that you just gave, explain how the financing would work, how Kachuwa would come in.
Yep. And by the way, there's a lot of these that are happening right now. They call it the silver tsunami, the baby boomer generation owning hundreds of thousands of small businesses throughout the country, and they're wanting to retire. They could sell in the conventional path through a broker or what have you, but a lot of them want to sell to their employees. But the employees may not have the financing or the funding to buy out the owner. And in some cases, the owner's providing a little seller financing. Sometimes they're not. Either way, the employees need to raise some money to help do the conversion to employee ownership and buy the company from the owner. So we will often, you can do it with debt. You can do it with a class of non-voting stock, especially when they're employee-owned cooperatives, but some combination of debt and equity from Kachuwa and usually multiple other sources. And there are also a lot of loan funds that specialize in these types of employee ownership conversions. But that group will provide enough funding for the employees to buy out the owner and become owners of the company. And then the idea would be, we want it to be employee-owned, usually for a very long time, not pursue some exit in 5 years. So usually we're happy to own that non-voting preferred stock that's paying a dividend. It's aligned with our impact themes. We're happy to own that stock for the long run. Sometimes they will, if the company grows, they'll refinance the debt or find a way to redeem the shares, but we're okay with making very long-term investments as long as it's an employee-owned cooperative. Over the long run, we're very happy to hold that investment. And in general, our co-op is a buy and hold portfolio.
Mm-hmm. And how does that work for the employees when you come in and do something like that? Are you preferred over the employees then, since you put capital in?
Yeah. So like at Namaste Solar, where my day job is, an employee-owned cooperative, the employees are the common stockholders, one share, one member, one vote, right? And those earn dividends, but preferred dividend rights are given to our external investors who own a class of non-voting preferred stocks. The preferred dividend rights, they need to be paid their target dividend of 6.5% per year first before the employees can pay themselves a dividend. And then if the company needed to liquidate, they also have preferred liquidation rights. So there are many different ways to do it, but that's an example of how it's done at Namaste Solar.
Interesting. And then what about with the startups? How do you do diligence? How does that all work before you make a decision? And how does this decision get made?
Yep. So our board of directors, which is democratically elected by our members, doubles as an investment committee. As we grow, we're likely to have a separate investment committee from our board and multiple professional staff managing the cooperative as we grow. Right now, the board doubles as an investment committee. We make all the investment decisions. And yeah, we do due diligence on every type of investment, regardless of what asset class it is. And luckily, we have a very diverse board, people with a lot of very diverse background and experience. We have some former venture capitalists have managed VC funds. We have multiple operators, former operator entrepreneurs, a CPA, a former CPA. We have a little bit of everything, and that helps us. Plus our membership. Sometimes we'll call on, say, a real estate broker who's one of our co-op members. We ask for advice from a lot of our members regularly, but be able to do due diligence like any fund managers would and make sure that it's the type of investment that is going to be a good fit for our cooperative.
And how many people are on the board?
Right now, there are 5, and then we have 3 advisors to the board.
Nice.
Yep.
Great. So I just love the concept of the Kachuwa Impact Fund because you're doing good while doing well, hence the name of my book. And you're diversifying in such a way that really does at least make the investor feel that they have, while they're doing good, while they have this great opportunity, they also have a really robust portfolio to know that, hey, chances are, of course, you can't ever guarantee anything, but like chances are you have diversified enough between the real estate and the fact that's spitting off revenue and some of the other things that you've done and the capital gains that are happening that there will be returns to the investor.
Yep.
You're not saying that you're guaranteeing anything, but it is definitely a different model than what I've seen before.
It is, and it's got its pros and cons. I think some people might look at it and say, well, wait, I could generate higher returns if I invest in conventional funds. A lot of the investments that we make generate a high impact return, like a loan to a CDFI might only earn 3 or 4%. That's a pretty low return. And we're generating a return on a portfolio wide basis. So we have some investments that are generating double-digit percentages and some single-digit percentages, everything in between. But some people could argue, yeah, I could make more by putting it in conventional fund. Some people want liquidity more quickly. When someone joins our cooperative, we're saying, you should plan on being a member of the cooperative for at least 7 years, and ideally a decade or more, because that's how you can generate the most return. Because some of our investments, there may not be that capital gain or 10 years or more, and we're never going to pressure any of our investees to pursue that liquidity event. We're very patient investors. That's part of what we're trying to do. Liquidity is an issue. Others might say our dividends are very lumpy because, yes, we're generating rental income each year and dividend and interest income, but we don't know. We can't predict when those years are going to be that one of our startups sells for a big capital gain, or when a nonprofit that we're supporting, they've outgrown the real estate that we've bought for them and they're ready to move out, and then it's time to sell that real estate and there'll be a big capital gain. So we show a graph to our co-op members. It looks like sawtooth, that our dividends are going to be very lumpy. It's going to be like sawtooth, and we can't predict when there'll be those ups and downs, but it will generate something each year. And the average that we're aiming for over the long run, the average over the long run is between 5.5% to 8% per year. And for some, that may be too low. For some, that may sound great for a diversified portfolio with lots of different risk profiles and all the different assets with really high impact. And I think our co-op members, what we're doing very much appeals to them. But yeah, there are pros and cons depending on your perspective, your vantage point.
You make a good point, but you're also saying that, hey, you can invest for impact and you can get returns. So sure, I like that you're looking at the long term, you're in it for the long game. A lot of cases, some people think, oh, if I invest in a private company and then it exits and I'm going to make all this money, I'm going to find the next Google. And we know that's not happening, right? Or maybe it is, but in a very small percentage of people. So how can I have a love-hate relationship with the word impact because I do want to invest for impact. I also do want to prove, and I think Kachuwa is doing that you can have impact and have returns too. And I think as long as you're really looking at it over the long term, right?
I agree. And some people say, well, what is impact? How do you measure impact? And it's very subjective. But the way our co-op measures it is we have 10 impact themes, and every single one of our investments needs to align with at least one, ideally 2 or 3 of our impact themes. And some examples of our impact themes are, one of them is cooperatives. Another one is employee ownership. Another one is renewable energy and energy efficiency. Another one is sustainable land use. So we like to invest in organic farmland and sustainable timberland, for example. Another one is companies that are majority owned or led by women and BIPOC. So we've got those 10 impact themes. Some of them are very easy to measure. This is either a cooperative or it's not. It's either a woman CEO or not. We like the simple to measure ways of determining whether or not it aligns with our impact themes. Some are ways of measuring impact are much more subjective, but we just try to keep it simple. And our co-op members know that going into it. These are the 10 impact themes that we're doing. It would be up to the co-op members or their elected board directors if we were to change that, but everyone knows this is what the co-op is pursuing. For example, a lot of our co-op members have given us feedback that they're very excited about investing in affordable housing. It's not explicitly one of our 10 impact themes, but it aligns with like another our themes is social justice. Or you could argue affordable housing aligns with that. But either way, we've decided to invest in affordable housing. There's a firm that's run by two women who are fantastic at developing affordable housing projects in a unique and different way. We're very happy to invest in those, partly because our co-op members wanted some investments in affordable housing and partly because we wanted to support those two women entrepreneurs who are starting to develop more affordable housing projects.
Amazing. Well, Blake, thank you so much for coming on the podcast today and explaining this all to us. Really very interesting. Where can people learn more about the Kachuwa Impact Fund?
Our website, it's a great place, KachuwaImpactFund.com, and Kachuwa is spelled Kachuwa, KachuwaImpactFund.com.
How'd you come up with the name?
It means tortoise. I spent 3 years in Nepal, and Sanskrit is to many Southern Asian languages the way that Latin is to a lot of Southern European languages, and Kachuwa means tortoise in a lot of those South Asian languages. And Tortuga and tortoise and a lot of those were taken, but we liked the idea of slow and steady wins the race. The message from the tortoise and the hare, it fits very well with the cooperative's ethos. So we decided to call it Kachuwa Impact Fund. And we knew that it would sound weird, but at least it was unique, like the fund.
I love that story. All right. Well, thanks so much for being here, Blake.
Yep. Thanks for having me.
Thanks for listening. To connect with me, visit my website at marciadawood.com. And please subscribe, follow, and leave a review. It helps the podcast get seen by more people. And remember, you can also find the Angel Next Door podcast on YouTube too. And if you're looking to learn more about investing in the changes you want to see in the world, sign up for Ann and Bill Payne's ACA Angel University classes. Go to theangelcapitalassociation.org, all one word, to find out the schedule. And classes are now available on demand. Many classes are offered, everything from angel investing basics, which include fundamentals, risk, due diligence, term sheets, valuations, returns and portfolio strategy, and even a class on group formation. There's even a deeper dive where you can get advanced classes, including capitalization tables, startup boards, and exit strategies. If you're not already a member of the Angel Capital Association, you can become one for a low price that will give you unparalleled access to discounts, free webinars with a huge archive of content, networking opportunities, and much more. We'd love to have you join us.
All content for this website is informational and not intended to serve as legal, tax, accounting, or investing advice. While Marcia, that's me, does serve on the SEC Small Business Capital Formation Advisory Committee, my views are my own and not the views of the SEC or my fellow colleagues on the committee. Our speakers and hosts are thoughtfully selected for their educational value, but their opinions are their own and do not necessarily represent the views of the host, me, or the Angel Capital Association, and neither specifically endorse the use of presenters' products or services. Listeners of the podcast should consult their own tax, investing, legal, or accounting advisors before making important financial decisions. All warranties, including accuracy, completeness, and suitability for specific purpose, are disclaimed.